So let's talk a little bit about the Federal Reserve and their new statement. They have changed the way that they are going to be conducting their monetary policy. It's not a major change, although I guess it is kind of a major change. It's still quantitative tightening, just less quantitative tightening. So now, if you've been following the Federal Reserve and their balance sheet reduction, this is the opposite of quantitative easing, where the Federal Reserve was printing up money and buying treasuries, putting those treasuries on their balance sheet. This is exactly the opposite. Quantitative tightening is when they allow the treasuries to roll off the balance sheet, and they were allowing quite a bit to come off every single month. I believe it was $60 billion worth of treasuries to roll off the balance sheet every month. They are going to reduce that reduction down to 25 billion come June. Now, this is quite significant to the balance sheet reduction scheme that has taken place, but it is still quantitative tightening that is happening out there. It's just less tightening that is going to be taking place. Of course, the market is going to see this as a very positive move coming from the Federal Reserve, and the idea that they are moving more towards an easy, stimulated economy. Geez whiz, I'm having a hard time talking. But that's not what's happening. They are just making it less restrictive at this point, and this is what we are going to be experiencing come June. Now, when I think about what it is that the Federal Reserve is doing with interest rates, that's probably more important than what it is that they're doing with the monetary policy as far as the balance sheet reduction. The interest rates are where the things that impact us the most, like as an individual. Now, of course, a lot of us are probably looking at the bond market as far as what it is that we can do for our investments, buying houses, starting businesses, whatever it is that we have going on out there. But as far as like the working class, everyday average Joe, the more meaningful impact to our lives is where the federal funds rate is going to be. And that is going to stay still. They aren't moving the Fed funds rate. And this is what a lot of people were anticipating. What the Federal Reserve was going to talk about was the adjustment of the Fed funds rate. However, that's maintaining, and it's the balance sheet reduction that has taken place. Now, let's think about that just a little bit. What does that mean, the balance sheet reduction? Now, when the Federal Reserve allows treasuries to roll off the balance sheet, that is basically allowing treasuries to come due, and when it comes due, that's money coming back to the Federal Reserve. The Federal Reserve then takes that money and essentially destroys it, right? That is literally money coming out of the economy. That's the Federal Reserve getting its liabilities back. So they were doing this to the tune of like $60 billion a month. They're going to reduce that down to $25 billion a month in June. Now we think about what is that going to do to the markets? Well, now all of a sudden, instead of having to absorb all this, treasuries that the Federal Reserve is allowing to roll off their balance sheet, the Federal Reserve is going to maintain holding on to those. Well, you think about like the Treasury Department having issues with liquidity coming into the future, and the idea that they would have to be there to buy back their own bonds. This is going to relieve a lot of that pressure. Right? The Federal Reserve then taking $35 billion a month, instead of taking that out of the market, the liabilities, they're going to allow that to stay in the market. That's going to provide the liquidity to the bond market, or at least some liquidity to the bond market, that I believe the Treasury would be looking for in a time of pressure. So instead of the Treasury coming in and buying those bonds, the Federal Reserve is actually stepping up here a little bit by reducing the balance sheet reduction. Does all that kind of make sense? So I think this is pretty important to internalize and understand, that it's not necessarily going to mess with the interest rates in the Fed funds level of things, but it will mess with interest rates when it comes to the bond market and where like mortgage rates and stuff like that will go. Of course, the Federal Reserve is not messing with the mortgage market as far as the mortgage-backed securities. They are going to continue to allow those to roll off at the same pace that they have been. So as far as the immediate impact to the mortgage market, I don't think that's going to be taking place with this balance sheet reduction. The roll-off reduction, I guess is the way to say it. I don't know. Anyhow, thought that I should bring this one up because I thought it was a really good, interesting topic to bring up as far as what it is that a lot of people are going to be saying out there in the mainstream media, talking about the Federal Reserve going into a pivot. This isn't exactly a pivot. right? I mean, it's like a slowing down before the pivot actually takes place, okay? Even though I put it into the description of it, I just did that to actually get the attention of people who are looking for that idea that the Federal Reserve has gone into a pivot. That's not what's taken place at this time. They are just slowing down prior to that happening. You got to think an actual pivot is when they go to move the reduction to either like a zero reduction part. Like they don't necessarily have to increase the balance sheet, but just the idea that they are no longer reducing it, and then dropping of interest rates. That would be the pivot, right? Right now, they are slowing down the pace, right? So instead of going, 60 miles an hour, they're only going to go 25 miles an hour. Right? And that's kind of the idea behind the reduction or the slowing down of the economy. I guess is worse, however you want to look at it. Anyway, kind of stumbling through my words here a little bit. Dishes every day. Thank you so much for the smiley face. All right, greetings, Simon, and all-nighter. Thank you so much, Johnny. Great to have you here. All right, Deja Vu says afternoons. All right, 5.5% win. Can you explain negative interest rates more? Negative interest rates is a really interesting concept to think about because really there is no proof that negative interest rates actually works. And to understand like what negative interest rates are, where are you looking to at the negative rate? Like, is it the negative rate at the sovereign debt level? Meaning like, say a US Treasury going into a negative interest rate? Is that, or the Fed funds rate? Like, where the central bank's, established interest rate is? Is it the interest rate on savings that you're considering as far as negative interest rates? There are a lot of interest rates to look at, and which one of them going negative is the one that most people are probably going to be looking at as far as what does this mean, right? Negative interest rates. So when I think about negative interest rates, I think about them at the Fed funds level, like the Federal Reserve itself, and where they have their overnight lending rate between the big banks. Now, this is a really complicated thing to understand because really these interest rates come down to what it is that they hold for their assets. Right? And then again, like, what is their assets? The assets are all the loans out there that the banks have given. Right? Assets are the loans, liabilities is all the money. See, like to us, we have to look at it differently. We look at liabilities at the loan. Like all the loans we have out there, our car loan, our mortgage loan, credit card loans, that's our liability. The asset is the money. The bank looks at it exactly the opposite. The asset is the loan and the money is the liability that they need back. Right? So it's important to understand it from that fashion because when you think about like negative interest rates, if you can imagine a loan with a negative interest rate attached to it, now how does this even occur? Right? Now, let's take it back again. Okay, because you have to almost go back to a circumstance in which that it actually occurred. I think it was in Denmark. They had some mortgage rates that had actually gone negative, which is really interesting to think about, like having a mortgage with a negative interest rate to it. Now, what had happened was, and this is, again, it's really complicated to try and wrap your head around, but once you kind of get the idea of what it was that was taking place, it makes a lot more sense. Because nobody's going to loan money to somebody in the anticipation that they're going to get less money back, right? That doesn't make any sense. It's like putting your money into a savings account knowing that if you drop $100 into the savings account, there's no way that you're going to get the $100 back. You're going to get more like 99. Nobody would want to do that. It would be like costing you money just to place your money into a savings account. That doesn't make any sense. That's what negative interest rates would be like. Now, if we can imagine a mortgage that has a negative interest rate, we take the idea of what happened in Denmark. Some of these mortgages were adjustable rates. Okay. Meaning that however they adjusted them once a month, every quarter, whatever it was. Now, at the time, central banks and all these governments and everybody around the world was moving into a stimulating aspect of things, meaning that they were buying up a lot of these assets, these loans. Okay. This was the quantitative easing, so to speak. Okay. So now the demand for bonds starts to pick up off of the speculation that the price is going to continue to go up. Now, if you understand how the bond market works, prices go up and yields come down. Now, just because the yield on the bond might go low doesn't necessarily mean that the bond coupon rate has gone negative, right? So a bond coupon and the maturity rate are set generally. Like, there's a lot of different types of bonds out there, but if you can imagine that it's set, like it's written out on contract, this is how much the face value of the bond is, and in 10 years it'll be worth that much. And here is the coupons, the interest rate that it pays. And all that is set. There is no changing any of that stuff. However, the price that you pay for that can fluctuate. And now, if you can imagine like a bond that has a $100 face value to it, and it has 10% coupons attached to the bottom, and once a year you can rip off one of those coupons and go and cash it in for the 10% interest that it pays, which would be like $10. So once a year you can rip off one of these coupons and go and cash it in for $10, 10% coupon rate to it. Right? So at the end of the life of the maturity of the bond, right, you get your face value, $100, $10 coupons, 10% interest rate on that face value bond, right? So the investor would earn $100, right? Purchase the bond for $100, has 10% coupon to it, holds on to it till maturity, gets the face value of the bond back, the $100 plus all the coupons, right? $10 a piece. The investor has made $100 off of that, right? 10% coupon rate, 10% yield. Let's imagine that the investor, instead of paying $100 for that bond, instead paid $110, right? So now the face value didn't change, the coupons didn't change. If the investor holds on to it till the end of maturity, they get the coupons, right? All the $10 coupons from it, and the face value. However, the original investment of $110 now means that they have made a $90 profit off of it. The yield has gone to 9%. See, it's still a $10, like nothing changed, right? Except for the price that the investor had paid. Okay, so now if you have all these investors out there buying bonds in that fashion, thinking, okay, I can buy this bond, right? Not for the yield that I'm going to get off of it, but instead I'm going to hold on to it, because if the yield continues to fall down, right, and come down, the price is moving up, right? Remember, the investor who could have paid $100 for it or $110, now this bond's selling for $120, right? The yield's gone down even farther, but the price that you can sell for it has gone up. So now investors are not looking at the yield and what they can get for the return, but instead they're looking at the price that they could possibly sell it for into the future. So they can buy this bond with the idea that they're going to sell it for a profit, that the price is going to go up. If the speculation into the bond market is significant enough, the investors will ignore the fact that the yield is no longer paying anything. Like, it could be low to close to zero. It doesn't matter to them anymore, because they are not buying this bond for the yield that it is paying. Instead, they are buying it off the speculation that the price of it is going to continue to go up. And if that speculation is prevalent within the market, then what will actually happen is people will begin to pay a price that then drives that yield into negative territory. And this has happened, many times in many different areas of the markets, whether it was a sovereign debt or mortgage markets. Now in Denmark, this is exactly what happened. And so some of these adjustable rate mortgages were in a situation in which the demand for these particular mortgage bonds had gone up so much, people weren't worried about the yield anymore. They were speculating on the price and what they could sell it for, that it literally went negative on the yield, and some of these adjustable rate mortgages went negative as well. And it was for a short time, from what I understand, and then they eventually went positive again. But that is what's one of the signs of, or one of the outcomes of a negative interest rate could be like. And this is what would drive it, is the demand for bonds with no expectation of the return on the yield, but the expectation or the speculation that the price that they could sell it for going into the future would go up. And this is what drives bonds into a negative territory. Nobody's going to buy a bond with a negative coupon rate to it. Like, that doesn't make any sense. Right? There might be some kind of like specialty thing out there where you buy this bond and then over time it matures into actual stock, and then the stock can be sold for a profit or something. There might be some weird kind of like crazy investment of something like that. But for the most part, people are looking at the yield that they are going to get off of a bond, or they're speculating on the idea that they would be able to sell that bond off into the future. See, this is when low interest rate environment starts to kick in, like we've experienced over the past, is that bond investors and gold investors used to be like the exact opposite of each other. Right? A bond investor would look at a gold investor and say, you're not investing, you're speculating, right? You got this idea that you're going to sell that gold off in the future for a higher price to somebody else. Bond investors will say, hey, we're buying this bond with the anticipation that we're going to get an interest rate off the coupon, right? Off the bond itself. So bond investors were just that. They were investors. Gold purchasers were speculators. However, when the yield on the bonds fell so low to close to zero, and that yield was no longer a viable investment, the bond investors turned into speculators themselves with the idea that they would sell that bond off into the future for a higher price. No different than the gold buyer, right? So bond buyers and gold buyers were essentially doing the exact same thing, right? And then as interest rates started to move up, people started moving back in, investors started moving back into the bond market again. All right. Did I explain all that all right? I left George Gammon's stream to come here. Well, I didn't realize George was streaming too. Right on. I have a limited time on which I can do mine, so I have to do them here on my lunchtime. All right, gold and real estate are opposite. Yeah, I believe that. Like, it's easy to understand the difference between a speculation and an investment, right? An investment will pay you. And it doesn't matter if it's a rental income or a business or something of that nature, but it has some sort of interest rate attached to it, or some sort of business where it has cash flow coming into it, something that you can make a profit from, right? When it comes to gold, it's literally the greater fool theory, right? That you would sell this off into the future for a higher price to somebody else who's willing to pay for it. Now, it's not meaning that it's a foolish investment, right? Or a foolish purchase. It's just the way they call it, right? This is what the investment community calls it. When you are speculating on the idea that the price of it will move up, and it doesn't really have any kind of other aspect to it. Now, I know a lot of people will look, it's like, oh no, it has industrial use and all this other, okay. Totally true, but that's still speculation, right? That you buy it today with the idea that the value of it or the price of it will move up, and then you can sell it off for a profit. And again, that's a complete speculation. Buying a business, rental incomes, dividend-paying stocks, stuff like that, these are true investments, right? Even just buying a stock in a company is an investment because you anticipate that that company is going to do well and, profit. So very, very different when you look at these two things. And, as far as the opposites go, I also think that they're complementary to each other. That if you were going to get into like real estate investing, then it would probably be nice to have something that is an insurance policy to back that up. That is completely out of that third party claim, because when it comes to real estate investing, that's exactly what you are doing, is you are tying yourself up with third parties. Like, I don't care how much you own your property or how remote it is, whatever. And if there ever came a time in which that you needed just a little bit of money, you're not going to be able to sell off just a little chunk of your property. You might be able to, but for the most part, you're not going to be able to sell off a little chunk of your property. You're going to have to go out and take out some sort of equity loan in order to acquire that money you need, or sell the entire property off. That's not exactly like security, in my opinion, right? Security is something that you can be nimble with, right? And that's where gold and silver and cryptocurrencies on a lesser extent can really, fill that position. All right. I also, I want to give a shout out and a thank you to Owen Benjamin, who I guess has been giving me some shout outs on his podcast lately. So I really appreciate that, and thank you very much, Owen. You got to get a hold of you, and maybe we can do an interview soon or something. All right, gold is cheap, real estate is high. It's never the same for long. I know I just needed an excuse. The UE is not a genie. He's not going to save you. All right. Is the best financial decision you can make okay, let's see here. cruise back up here a little ways. Goals. Okay. How does that apply in the car industry? Just pretending a negative rate situation. I mean, how would it look in the cars? Like, I think about it. If you have a negative interest rate on a loan, what happens to the asset that's backing that loan? Right? Like, if you have $100 loan, and over the course of the years you're going to pay back $99 of it, right? And say I'm the owner of the asset and I'm the one who is going to take on the finance the asset as well, meaning I'll take payments for this particular house. Now, we have a negative interest rate, meaning that I want to sell this thing for $100, right? We're just going to assume some numbers. We're going to sell this thing for $100. And over the course of the loan, I'm going to get paid back $99, right? Not only that, right? But if the loan gets paid off earlier, I would get paid more. So the chances of that taking place are probably going to be very nil, right? Because the negative interest rate applies to the length of the loan. So if you paid it off earlier, then you would end up paying a higher price for the asset, right? So you'd want to stretch it out the entire length of the loan to absorb as much of the negative interest rate as you could, right? So now me, if I own the asset and I am going to finance this asset at a negative interest rate to somebody, knowing that if they took the entire length of the loan, that I would be paid back less than what the asking price of the loan is, then I would probably end up asking for a crap ton more for the asset itself. Like, I would incorporate the loss of negative interest rate into this loan and tack that onto the price tag of it. So knowing that if I sold this asset at a negative interest rate, that I would get back $99 on a $100 loan, right, because of the negative interest rate to it, then I would sell that asset for $103 to absorb the negative interest rate so that then I could get my profit again. So what would happen to the asset prices of all the negative bearing loans out there? The asset price would go through the roof to make up for the negative interest rate. And then tell me, how many people out there are going to write a loan saying, yeah, don't pay me back early, right? Or don't, like, everybody wants to be paid back early. They want their money back, right? And the only way that you would get paid back early is if they chose to take the borrower chose to take a punishing hit by paying it off early. If they had just waited and paid it off over time, they would end up paying less money. How prevalent do you think this is going to be within the business-minded people? This is what I'm kind of getting at. Like, asset prices would probably go screaming higher, knowing that if they lent or if they were taking on financing at a negative interest rate to sell this particular asset and they held on to it for the length of the entire loan, that they would end up getting back less profit than if they were to, sell the entire thing quickly, or not over time. Doesn't make sense, right? However, if you're in a negative interest rate environment because you have a cashless society and everybody is using digital currencies and you are forced into the banking system because you have no other way of making purchases or getting paid or paying taxes, then I think this thing could actually work, I mean, I don't know about work, but I think that they could work it, I divorced my wife and left my kids to come here. All right, moving on. All right. Tax increases coming. Okay. A furniture giant here in New England penalizes you for early payoff on credit purchases. Yeah. All right. How is Treasury going to finance the buybacks? You may have already covered this. They have cash now in TGA, but they will need to offset it somehow. The government doesn't have a budget surplus. Well, I don't know about that. I think they do have a budget surplus. I understand that a lot of people may argue with that, but they are not using the complete TGA account for running their daily expenses, or however to speak. That TGA account is sitting on more cash now than they had during the second round of stimulus that came out, right? So that TGA account is the credible threat, right? See, this is something else that somebody was saying. It was just like they're still saying like the Federal Reserve is lying when it comes to like the crying wolf aspect of the credible threat. That's not true, right? A credible threat means that they will actually do it. They will actually do it. Now, they have the money to do it. They have the proof to do it. They're making the statements that they will do it. But will it actually happen? May not. The willing market participants may come into it. The Federal Reserve is adjusting their balance sheet. There's a lot of things that are coming in that might not have the Treasury actually doing the bond buyback, even though they say that they're going to do it and that they have the position to do it. Putting themselves in that position, it's like literally putting the guy there with the whip, telling people to work. And if they don't, he's going to whoop them. And everybody knows it. And that's exactly the position that's in, right? The Federal Reserve is moving into a position that is going to make that bond market, the liquidity issues within the bond market ease. That balance sheet reduction, right? Going from 60 billion down to 25 billion. That is going to ease the pressure within the liquidity market, or within the liquidity aspect of the bond market. The Treasury being there with the cash in the announcement and actual doing it. Like they are in the process of making this happen. They are doing some bond buybacks, not on a significant scale, but they have started it already, right? This is the credible threat. They have the ability to do it. They are making the announcements. They are positioned to go for it. All they have to do is just make it known for everybody, and they will then take care of business, and they won't even have to do anything. The Treasury and the Fed won't have to do anything. They can just sit there and watch it happen. If it doesn't work out the way that, in that fashion, where the market starts to come in and participate, they will. They will jump in and do it. And that's why it's a credible threat. It's not just a threat, like an idle threat, right? Where somebody can say, hey, we're gonna call their idle threat. You can't. It's not an idle threat. It's a credible threat. They will do it, All right, I see some super chats there. Let's go check those out. All right, DB, thank you so much for the $5. What entity is going to purchase or hold my mortgage at 2.875% in the high interest, high inflation environment? The Fed? Well, it's probably going to get packaged up with a bunch of other mortgages into a mortgage-backed security. So even though yours is paying a very low interest yield to it, it will be in combination with a bunch of other mortgages out there. So yours is a super safe, probably, considering it's 2.87, almost guaranteed to pay. Then you get somebody else down there who might have a 7% interest, and they're risky and they may not pay. But you combine these two into the mortgage-backed security, and now you have a payment of somewhere in between there. And of course, they cut these up into tranches and stuff like that. So even though yours isn't exactly an ideal loan for a bank who has to deal with interest rates that are much higher, when you package that up into a bunch of other ones, then it has some sort of like security aspect to it when it comes to the mortgage-backed securities, right? So, I mean, I might oversimplify that a little bit, but when you ask who is going to be purchasing that, the investors will. Did I see another one, or was that it? Oh, there we go. Infamous NYC, thank you so much for the $5. If the Fed's going for 2% inflation year over year, debt already has negative interest rate, the money paid back are always weaker than the dollars loaned by nature. If the Fed going for 2% inflation year over year already has a negative interest rate, the money paid back are always weaker than the dollars loaned by nature. Huh. I think I'm missing that one a little bit. Sorry there, Infamous NYC. Thank you so much for the super chat. Hey, my brother, new subscriber from London, England. Well, thank you so much, Star. Thank you for being here. Margin Call. Yeah, that's exactly right. If you guys haven't seen that movie, Margin Call, or The Big Short, that's a good one. The Big Short is a great one, talking about the mortgage-backed security market during the great financial crisis, and really explains that whole thing too, how these things got packaged up and sold off, and what that does to the mortgage market. What time is it? I got a few more minutes here. Very good point. All right, grow what? Any other questions? Anything else we need to go on cover? We're 30 minutes into this. This is probably a pretty good one for this live stream. I really appreciate everybody being here. We have 382 people watching with 118 likes. That's awesome. I love it when you guys hit that like button like that. We got $10 in super chats because you guys are always so supportive of this channel. I really appreciate all that. I hope this information helps out some. I hope it kind of breaks down some of the things that are happening out there. A lot of times we look at it from a political mindset that really throws an obscure view when it comes to monetary policy. Understand fiscal policy separate from monetary policy is absolutely critical to understanding the economy, because monetary policy has more of an impact on our individual lives, on the decisions that we make, the loans that we take out, the businesses that we start, how it is that we spend our money is more, centered in on monetary policy than fiscal policy. Although fiscal policy is very much in our face, it's it's all over the mainstream media, and it's given a lot of attention towards the economy. But as far as impacting your personal life, interest rates, monetary policy, I believe has more of an impact on your personal daily life than any of that fiscal policy stuff that's happening out there. That's more about, creating noise than it is any kind of real benefit or change to you. All right, U.S. bond fund based mutual funds are losing money, not safe, but what the old people have been guided into. That's right. I think Infamous was perhaps saying that inflation means that rates are already negative in real terms because the money they return has devalued. Oh yeah, that does make sense, Brody. All right, this is my favorite YouTuber. Well, thank you, Investing with Cole, man. I really appreciate that. You guys are very cool. All right. Hey, thank you very, very much, Van E, for the $5 that just popped up there on the super chat. Debts are paid early only if assets management cost rises. Look at cost of property tax in Florida. Not everyone can keep their 2% loan if property tax is high. Yeah. It is. Like, I think about, like, even here in my own area, it has become very difficult. Like, buying the house and getting the payment was not that big of a deal. It was a big deal to do it, like to get it all in. Once I got it, it was like, okay, cool. But what ended up hitting that ended up hurting a lot more, and it wasn't like it was that bad, but it was the uncertain. It was this being so uncertain and not knowing. And that was a year after I had purchased the house. I got hit with a huge increase in the insurance of the house, which just really increased the payment. And I'm thinking to myself, well, I can cover that. That's not a big deal, right? But I'm thinking people who are right to the very end of their budget, that would be so devastating. I mean, that was like, I think it was an extra $2,400 a year or something like that. And I'm like, my God, if somebody was like, right to the very end of their budget, that could have been a devastating event that happened to them. And so when you have such a situation that has taken place, people are so debt saturated, any kind of increase or, downturn in their income leaves people very vulnerable, and this is the situation we're in for a lot. All right. Sounds about right. Powell said, cry harder, not enough peasants revolting. Yeah, I kind of agree with that, Van E. I think really it's the Federal Reserve is now looking for, I got Life Flight coming in. The Federal Reserve is looking for unemployment to rise before I think they really have any kind of interest rate adjustment. Like, that's going to be like their major indicator of when they're going to adjust interest rates. For the people who are trying to find when the Fed moves, I think once unemployment rises, that'll be the key moment. Is SoCal, my insurance went up almost $200 a month thanks to fire risk. Yeah, I don't even have a fire risk. I think it was just replacement cost of the house. All right, there is data that shows the consumer debt payment to income ratio is almost lower than it's ever been. Yeah. Shows that consumer debt payment to income. Government debt bad, consumer okay, and I think fixed mortgages has something to do with the consumer debt payments are so low. I told my wife I need to buy another guitar as an investment, hedge against inflation. I don't know, I heard guitars are getting cheap. Alrighty guys, not just fire risk, State Farm left California, so now the market needs to take up the uninsured demand. It's crazy. All right, guys, this was a lot of fun hanging out and talking, but I got to go back to work. Thank you so much for being here. We got 432 people watching with 147 likes. Thank you so much for hitting that like button. $15 in Super Chat because you guys are always so supportive of this channel. I really appreciate you guys doing the Super Chats for me. All right, Uneducated Economist, you guys let me know.